we are doing the chapter Futures in Derivatives. In that, we are doing the area Fair Futures Price Calculation. Today we will be doing few more problems in Fair Futures Price. Discuss about the concept of convenience yield, basis, and the concept of contango and backwardation in futures market, and also arbitrage when the actual futures price is different from the fair futures price. No arbitrage boundary in case of imperfect market. These are all the issues we'll be discussing in today's class. Tomorrow's class will complete the futures chapter by discussing about hedging through futures. If you look deep, this chapter doesn't have any great concept underlying it. It is more about understanding the market terminologies, how the market works, rather than deep academic concepts which are involved. Unlike options where you have lot of discussions regarding the valuation models, short selling, or the option boundaries, put call parity, etc. Such intricacies will not be there in this chapter because it is simply a forward only futures. We don't have too much to learn about a forward or futures except how the market works. Once we complete the chapter futures, I will do in one class currency futures, which is left out in the application of derivative chapter. Then we will be doing interest rate risk management, where I will be covering forward rate agreement, interest rate futures, interest rate swaps, and the interest rate options or interest rate guarantees. All this will be discussed in this interest rate risk management. Even this interest rate swap alone we will be doing as a separate chapter with a very important concept called as swap valuation and swap rate determination. I already told you, if I remember, that you should revise the bond valuation chapter thoroughly before we start with the interest rate swap chapter, because bond plays a very important role. Mainly the forward rate calculation is very important in the swap calculations. So please revise that before you go for the interest rate swap chapter. At that time, we don't have a time to discuss once again the forward rates elaborately. We have spent that time in during the bond evaluation chapter discussion. Okay, now let us summarize what is done in the futures chapter till now before I proceed further. We saw that for any security or a share there can be two markets, cash market and then futures market. Price quoted for a TCS share in cash market is what price? Spot price. Price quoted in the futures market is a forward price. The price quoted in the cash market is a price at which I can buy and sell today. Futures market price is a price at which I agree to buy and sell on a given maturity date. This futures position which I take can be a buy position or a sell position. We call as long futures, short futures. And on the maturity date of the future, we should not think that we are going to deliver shares or take money when I am selling futures, or pay money and take delivery of shares, etc. Because most of the futures transactions are settled otherwise than delivery. It is called as cash settlement. The exchange gives a counter buy and sell for your position at the prevailing settlement price on the maturity date and books profit or loss. One person books profit means other should be booking the loss, and the amount will be transferred between their margin accounts. Can I exit before the maturity date? Yes. If you have a buy futures, give a counter sell. If you want to come out, sell futures, give a counter buy. And you exit by giving a counter at the prevailing price on the date of exit. Then we saw that the exchange is going to be acting as a counterparty for every futures transaction. To protect itself against a counterparty risk, exchange asks the deposit margin money while entering to the futures contract, so that the profit or loss can be credited or debited in the margin account where the margin money is deposited. The initial amount which they ask me to deposit is called as initial margin. And when I keep on incurring losses, the initial margin may reduce. Beyond certain level, they don't allow the margin account balance to go down. That is called as maintenance margin. When it reaches a maintenance margin, they ask you to deposit some money. The amount to be deposited is called as variation margin, which is initial margin minus the balance in the margin account. Now, in the futures market, they don't book the profit and loss at the end of the contract period or not on the date of your exit, but they book the profit and loss on a day-to-day basis using a procedure called as mark-to-markup procedure. In this case, every day the contract will be closed and open next day. Your buy futures will be closed through a counter sell and the sell futures will be closed through a counter buy at the settlement price fixed by the exchange. Settlement price can be understood to be the last traded price, but the exchange may take last few minutes weighted volume average traded price for fixing the settlement price. So when they book a profit or loss in today's settlement price, next day my futures contract opens not at my futures price but at the recent settlement price. So this is what has been discussed in the mark-to-market procedure. I think everybody, are you following or not? No. And then next we discuss that initial margin when they fix considering the volatility of the stock. Riskier the stock, more will be the initial margin asked. They fix the initial margin using a procedure called as VAR, value at risk. And the software fixing that is called as SPAN, Standard Portfolio Analysis Software. Then we also discuss about the concept called as open interest. In share market, the number of shares the company issues and listed will be the open interest, on which the secondary market people will be buying and selling it. If at all the open interest should be changed in the share market, company has to go for a new public issue or should be buying back the shares. In futures market, open interest is created by the investor themselves. When two new parties create a futures contract, it creates an open interest. When one new party is entering into a contract, another old party gives a counter portion to dilute his position. In that case, open interest will not be created. There is only a transfer of one buyer to another buyer. That's all. Third is, two old parties are liquidating their position. In that case, the open interest gets reduced. This open interest shows the depth of the futures market for a security. That is huge open interest in the futures market means a lot of secondary market available. You need not worry about the future buy or future sell. There is enough open interest to take care. Otherwise, you only depend on the new entrant to come out through liquidation. This is what we discuss in the open interest. And then we started discussing about the fair futures price. Up to this, we have done this particular chapter. Everybody, are you all able to understand or not? Any correct? No. Yes or no? No. Then we discuss what should be the fair futures price. If the actual future price is different, we can make profit or loss. That is, we can make an arbitrage profit out of it. So fair future price, unlike option, is not very difficult. There is nothing but future value. What is future value? Present value compounded gives you future value. Nothing great about the fair futures price fixing. Now can we continue with the fair futures price or not? No. Please, all of you. See, we are discussing about fair futures price. These are all the things we discussed first. Fair futures price is equal to what? Spot price into e power tr. Spot price into e power tr. Now, I use a continuous compounding. Normal compounding also if you use, nobody can dispute because it all depends on the examination question. Okay, whether given you the e value or not. I just did compounding, that's all, but we have done the continuous compounding here. Can you proceed or not? No. Next is fair futures price. When the asset declares dividend, suppose the share declares what? Dividend. In that case, dividend can be given as percentage or can be given as what? Amount. If the dividend is given as a percentage, given the dividend yield, in the case what happens here? spot price into e power t r minus d. Now this is my interest cost which gets recovered through what? A portion of the dividend percentage. The net only should be recovered. Yes or no? Suppose they give you the dividend as what? Amount. In that case, what happens here? Revised spot price into e power tr. What is revised spot price? Spot price minus present value of dividend. That's all we discuss. Innappa right or not? No. We use this to find out the value of stock futures as well as index futures. And when the actual future price is different than this price, what happens? Arbitrage existed. How to earn that arbitrage profit can be seen in the problems today. Understand that when the actual future price is different than the fair future price, there exists an arbitrage opportunity is an issue that is being discussed. Everybody, can I proceed or not? Now, in that, I think we have completed question number 9, 10, 11, 12, 13. I said I'll be doing it later. Now we did question number 14. Question 15 is an ICAA examination sum, a good problem. Let's do question number 15. And then we'll discuss some small theoretical issue like the convenience yield, the contango, backwardation, basis, etc. And then come back and do more problems in the commodity futures, fair futures pricing, and then go for arbitrage. Now, today's class, there's going to be no great discussion we're going to do again, but we'll be learning some terminologies, same discussion, repackaged and presented in what? Different ways, that's all. Just to understand different varieties of question, not like the previous two classes where lot of discussions were made. Can I proceed or not? Now, please. Take question number 15. Take question number 15. Nifty futures trade on NSE. Nifty futures trade on NSE as 1, 2 and 3 months contracts. Spot Nifty stands at 1200. BSAF, which currently trades at rupees 120, has a weight of 5% in Nifty. It is expected to declare a dividend of 20 per share after 15 days of purchasing the contract. The cost of borrowing is 15% per annum. What will be the price of new 2 months futures contract on Nifty? That's a question that has been asked. Please go through the problem before I start with the solution. Please read the question quickly. Please, when you read the question, apply your mind, try to find the answer for it. If still you don't, we'll be doing the solution. Please go through the question quickly. Okay, now see. Question number 15. Stop talking. Question number 15. My question is, Nifty is a share of portfolio. It is called as what portfolio? Market portfolio. We discuss in portfolio. Yes or no? No. Nifty is a portfolio. Inside a portfolio, so many shares are there. Right or not? Nifty will be having top 50 companies shares. Okay. Now, Nifty is said to be declaring dividend if the company is inside the Nifty is declaring dividend. Yes or no? A portfolio declares dividend if the share inside the portfolio declares dividend. Right or not? Now, in this Nifty, one of the company inside is what? BSAF. It declares dividend or not? Yes. Okay. Now, they ask you to find out the Nifty futures price. Ask you to find out what? Nifty futures price. How many months futures? How many futures here? Question about how many months are? 2 months futures. Okay. Now 1 month, 2 months, 3 months are trading in the market. Your question is to find out the price for what? 2 months futures. Point number 1. Yes or no? No. Futures price is equal to spot price compounded. Spot Nifty is given. What is spot Nifty? 1200. If I compound to what? The second one, I'll be getting the futures Nifty. If there is no dividend declared by the stock inside the Nifty, yes or no? No. But during this 2 month period, is any stock declaring dividend? Yes. What is the stock? BSAF. That BSAF declares dividend when? After half a month or after 15 days. And this BFAF share is constituting how much percent of my Nifty portfolio? 5% of my portfolio. These are details given. First I have to find out the revised spot Nifty and then go for what? The compounding. Now, see. When we do Nifty, we just make it into a contract size and then do it. Okay, we cannot buy and sell one Nifty futures. You can buy and sell only what? A Nifty futures contract. Can I buy and sell one TCS futures? No. I can buy only one say TCS futures contract, which is 250 shares we discuss. Yes or no? Now, today, a Nifty contract size is 100 Nifties. How many Nifties? 100 Nifties. When I go to the futures market, I have to give a buy order and sell order only in multiples of what? 100 Nifties. I cannot give a buy and order, sell order for 20 Nifties. Everybody, are you following or not? No. But it changes. In the second previous batches and all, I used to do the problem with 200 Nifties. That was the contract size. Are you following or not? Now, the contract size, how many Nifties here? 100 Nifties. The exchange sometimes revisits the contract size. As the value becomes bigger and bigger, the contract size will become what? Smaller and smaller for enabling the investors to invest. Everybody yes or no? No. If the value becomes bigger, contract price also remains same. Now, small investors cannot enter into the market. So, it is a policy decision of the exchanges to fix the lot size. Everybody, are you following or not? I think I discussed this already in one of the previous class. Can I proceed? Now, let us do it together. When you do, you'll be understanding the solution automatically. No need to do and then copy. Can I proceed? Write down question number 15. Question number 15. Okay. Point A. Shall I start or not? Now. Value of one Nifty contract. Value of one Nifty contract. I not use a Nifty futures. I have said what? One Nifty contract means what? Spot contract. Okay. Value of one Nifty contract. Everybody tell me, one contract is how many Nifties here? 100 Nifties. A Nifty is having how much value? 1200. 100 into 1200 gives how much here? 1,20,000. 1,20,000. Value of one Nifty contract is 1,20,000. Okay, now this is a share value, portfolio value, portfolio value. Inside this, I am having one of the share called as what? BSAF. Now, point B, value of BSAF inside one Nifty contract. Value of BSAF inside one Nifty contract. This entire Nifty contract is BSAF share? No. It is having what? So many shares. Invest BSAF constitutes how much percent? 5%. It constitutes 5% of the portfolio value. 5% into 1,20,000. What number? How much base here? 6,000. Value of BSAF in one Nifty contract is 6,000. Everybody, yes or no? Now, next, C. Number of BSAF shares. Wait along with me. Number of BSAF shares inside one Nifty contract. Number of BSAF shares inside one Nifty contract. If we see today, the market price of BSAF is how much rupees here? 120 rupees. What is the value? 6,000. 6,000 divided by 120 is equal to how many shares? 50 shares. You can say inside every Nifty contract there is how many BSAF share here? 50 BSAF share is present. Like that we can imagine. Everybody is or no? So 50 share is there. Now next is dividend inside one Nifty contract. Dividend inside one Nifty contract. Can you tell me how much is a dividend declared by the BSAF? Answer me, how much rupees? 20 rupees, huh? 20 rupees into how many shares inside the contract? 50 shares. Is equal to how much here? 1,000 rupees. Is equal to rupees 1,000. Dividend inside the Nifty contract is rupees 1,000. Everybody, are you following or not? Now, my question is, this 1,000 is an amount today, after 15 days, after 15 days. The next step is to calculate what? Present value of dividend. E. Present value of dividend inside one Nifty contract. I'm always using this term. I'll explain this once again to have clarity later. So present value of dividend inside one Nifty contract is equal to 1,000 rupees into e power minus 0.5 by 12. 15 days means half a month, na? Minus 0.5 by 12 into yellow percentage 0.15. 1,000 into e power minus 0.5 by 12 into 0.15. Can you turn to the next page? I think you're all finished copying it or not? Now everybody tell me yes or no. Now present value of dividend inside one Nifty contract, 1,000 into e power minus 0.5 by 12 into 0.15. E power minus 0.5 by 12 into 0.15. That side, are you all following about? Now, can I proceed further? Now, let us simplify it, which is equal to, please tell me, 1,000 into e power minus 0.00625. E power minus 0.00625 is equal to 1,000 into 1 by 1.00627. Okay. So 1,000 into 1 by 1.00627. Tell me what is the present value of the dividend? 993.77. Okay. 993.77. 993.77. Okay. Now, yes or no? This is a dividend per Nifty, dividend per Nifty contract. Tell me. Dividend per Nifty contract. This is a dividend for how many Nifties? 100 Nifties. Yes or no? Are you following or not? Now, point E, F, F. Okay. Next is present value of dividend per Nifty. Present value of dividend per Nifty. Okay. Is equal to 993.77 divided by 100. 993.77 divided by 100 is equal to how much here? 9.994. 9.94 is equal to 9.94. 9.9377 made us 9.94. Then present value of Nifty. Yes or no? Dividend in Nifty. Next is what? Now guess here. What is the next item? Revised spot Nifty. Revised spot Nifty is equal to 1,200 is a spot Nifty minus 9.94. Am I right or not? 1,200 is a spot Nifty minus present value of dividend 9.94. Tell me the amount here. What is the amount? 1,190.06 is equal to 1,190.06. 1190.06. Everybody, can I proceed or not? No. This is called as what? Revised spot Nifty. I want Nifty futures price or not? No. What is futures price? Revised spot price into e power TR. It or not? No. Next is what? H. Okay. Next, right? Nifty futures price is equal to revised spot price into e power TR. Revised spot price into e power TR. What the revised spot price? 1190.06 into e power. How many months futures? 2 months. 2 by 12 into 0.15. 1190.06 into e power 2 by 12 into 0.15 is equal to 1190.06 into e power 0.0 is equal to e power 0.025. 1190.06 into e power 0.025. E power 0.025. Everybody understanding and writing it or not? Now, tell me, what is that simplify? Can I turn the next page or not? No. Which is equal to 1190.06 into 1.0253. 1.0253. What is the amount here? 1220.15, yeah? 1220.19. 1220.19. 1220.19. Nothing great, a simple calculation where the dividend is given for a share in a Nifty. Now, I'll once again explain this, where sometimes confusion may arise. I'll have a discussion once again, and then go for the next sum. Please settle down. Now, first of all, this 1200 is value of one Nifty, yes or no? This is value of one Nifty. It is not rupees generally, it is points. It is nothing but what? Points. 100 Nifty will be having how many points here? 1,20,000 points. Okay. Now, see, understand that this 6,000 need not be the market value of a BSAF share. Everybody understand what I am saying? Now, this 6,000 need not be what? Market value of the BSAF share. 1,20,000 is not the market value of all the 50 shares. That also understand that. I'll say suppose the market value of all the 50 top stocks in the Nifty, that is the number of shares of TCS into the market price, the number of shares of Axis Bank into the market price, number of shares of Tata into market price. If you just multiply and add it, I don't say it should be equal to what? The Nifty money, because Nifty is only a points capturing that. It is a base 100 and it keeps on capturing the movement up and down. Is or no? No. I don't say 1,20,000 rupees is what? The market value of all the Nifty shares. I don't mean that. Are you following what I am saying? But the proportion between the 1,20,000 and what? The market price is always going to be what? True. And the proportion of BSAF to the market value of all the shares. Do you understand my question or not? Now, in that case, what happens is 1,20,000 rupees is not the market price of all the shares. It is only what? The index point that is representing the market price. Something like a sample here. Something like what? Sample. Yes or no? Now, what I try to say is Nifty is a sample. Nifty is what? A sample point that captures a market. Let us imagine, okay, in that case, what is true for the population will be true for the sample also. Yes or no? In the real population, BFCA shares constitutes what? 5%. In the Nifty also it constitutes what? The 5% only. Should I repeat that? Now, BSAF share is constituting 5% of the entire market value. 5% of what? Entire market value. Here when I mean market, I mean only what? The market portfolio consisting of what? The top 50 company shares. Yes or no? No. In that case, then for 5% of the BSAF is 5% of the market value. May be 5% of what? The Nifty value also, because the Nifty is only a market representative. Everybody understood or not? In that case, now I say the value of BSAF share share is how much rupees here? 6,000. I don't mean to say that this is the market capitalization of BSAF. I don't say that because what the market capitalization of BSAF, the number of BSAF shares in the market into what? In market price. But I can say this is a miniature market capitalization. Are you following? The market capitalization in rupees is market capitalization in what? Index point. Like that one can understand it. Now, third case. Now, this is the number of shares. How many shares is there inside a Nifty contract? One Nifty contract is consisting of what? 50 shares of BSAF. One Nifty contract consists of 100 Nifties. This 100 Nifty portfolio will be having how many shares of BSAF? 50 shares of BSAF. And I don't say this is a total number of shares of BSAF. I say this number of shares of BSAF to be imagined inside what? A Nifty contract. And the dividend inside the Nifty contract is how much rupees? 1,000 rupees. Again, I don't say BSAF has declared what? 1,000 dividend. The dividend that can be attributed to one Nifty contract is how much rupees here? 1,000 rupees. And when I calculate present value, that you can know. So this is the present value of the dividend inside the Nifty contract. And inside every Nifty it is going to be what? Divided by 100. Then I have the revised spot price and then find out the future value. Everybody understanding what I am discussing? Now, because now nowhere I said that the market value of the 50 company shares is what? 1,20,000. I say the value of one Nifty contract is 1,20,000. The value of BSAF shares that can be imagined inside Nifty contract is 6,000. The number of shares of BSAF that can be imagined inside Nifty contract, how many shares here? 50 shares. The amount of dividend to be attributed to one contract is how much here? 1,000. The present value is 993. Present value per Nifty is divided by 100. And then find out the futures Nifty value. That is how when the company inside the Nifty declares a dividend in amount, we can find out the fair futures price. Everybody, are you understanding it or not? Now, this is one of the ISWA final exam question. How they have done the answer? Same way, just completed the solution. Everybody, can I proceed further or not? No. So now we are discussing the concept called as what? Fair futures price. Nothing great has been discussed. Future value is spot price taken to future. Yes or no? Spot price into e power TR. You can say if the question does not give you e compounding, it is nothing but what? Spot price into 1 plus r power n. Simply future value is equal to what? Present value into 1 plus r power n. Spot into 1 plus r power n gives you what? The futures value. Point number 1. Accepted? Now, point number 2. If there is a dividend of the share during the futures period, what I said is, when I exercise the future, at that time it becomes a ex-dividend future, and now the share is trading at what price? Come dividend price. So we cannot take the spot price straight away. We should adjust for the dividend. Yes or no? In that case, dividend can be given as an annualized percentage, or dividend can be given as an amount. If they give the question as annualized percentage, adjusted against what? The rate of interest. Something similar to what we did in the currency options, where the home currency interest rate has been adjusted against what? The foreign currency interest rate. In this case, e power t r minus d. I want the return of r. That gives me what? D. The net return I want through the futures price is only r minus d. Next, fair futures price is equal to, when they give you a dividend in what? Rupees, it is revised spot price into e power TR. Where the revised spot price is spot price minus present value of dividend is what we have discussed. In this, when the dividend is given for one company inside a Nifty, how we have to do it? One day has been discussed in the previous sum, or just to conclude a problem. Everybody, are you understanding it or not? Those who understood, raise your hand. Are you listening or not? Can I proceed? Let's go to the next discussion. Yes. Okay, now please. Till I come to the arbitrage, we are not going to discuss anything substantially new, but different way of presenting and different terms that may be asked in the exam. Even though the calculation may be very simple, 1 second calculation, one should know the terminologies. That's why we are going to discuss the next 10 or 15 minutes, I'll discuss some terminologies and then continue with the fair future price for a commodity future. Please, can we start or not? Now, please. Shh. We all know that spot price compounded to future will be the future price. That is called as fair futures price. Okay. Now, futures price is equal to, okay, futures price is equal to spot price plus cost to carry. CTC means what? Cost to carry. These are all different ways of presenting it. Yeah? Nothing great. Concept, adhe concept na. Spot price taken to future gives you what? Future price. Futures price is equal to what? Spot price plus cost to carry. This term will be much more appropriate when we discuss about the commodity futures now. Okay. That's why now using the word called as what? Cost to carry. Okay. Now, let us understand the concept before I proceed further. Now, see. Suppose I want to sell some bales of cotton. 100 bales of cotton. Cotton is measured in bales. 100 bales of cotton. Bales not like units, okay. Or suppose I want to sell 100 bags of wheat. Now, the commodity is what? Wheat. I want to sell 100 bags of wheat after 6 months. For example, after what? 6 months, I want to sell 100 bags of wheat. Okay. Now, I ask you a question. Which is better? Buying 100 bags of wheat now, keeping it and then selling after 6 months, or having a futures buy contract, using it, selling after 6 months. Did you understand an order? Now, see, two things here. Now, I can go to the farmer, procure the wheat now itself, store it, and then what? Sell after 6 months. This is one option. Or I can enter into an agreement. I can enter into what? Agreement saying that after 6 months, you straight away deliver to me and I can immediately sell it. Are you understand what I am saying? But at the price agreed today, there you may say risk is there. I cover the rest through what price. I say that please supply me the 100 bags of wheat after 6 months at this particular price. Everybody is or no? Now, tell me. I ask you a question. Suppose a wheat bag today, yes, I don't know exactly the price and all. I am poor in commodity tracking. Suppose a wheat bag today is costing something around, say, 2,000 rupees. Someone may say a bag of wheat maybe costing 2,000 rupees. Okay. Now, if somebody offers you 2,000 rupees as a price of the bag today, or after also what? 6 months, both price offered same. Which you will prefer? Yeah. Buy spot or buy futures? Buy futures, because anyhow I am going to get the bag at 2,000. But if I buy today at 2,000, following things happen, I have to store that wheat. Yes or no? I am going to incur what? A storing cost, and some kind I have to take what? Insurance on that. I incur what? Insurance premium, and there is going to be also what? An interest lost in the money blocked in. Right? And what I am saying now, all this makes the 2,000 paid spot more costly than the 2,000 paid on future. Yes or no? That means for the spot price and future price to be equally good, to be what? Equally good, the future price should be more than spot price. It should be what? Spot price plus cost to carry. Spot price plus what? Cost to carry. That is, suppose 2,000 rupees is a spot price. For storing the wheat for 6 months, along with the interest cost, is 200 rupees. Now, the future price should be fairly, how much rupees here? 2,200. Paying 2,200 and buying the wheat back after 6 months is as good as what? Paying today 2,000 and storing it for 6 months. Everybody, are you following what I am saying? So, what they always say is, having a contract rather than having an asset is advantageous. Having a contract rather than what? Having an asset is advantageous, because having an asset involves what? The cost to carry the asset, but having a contract, I need not carry the asset. Everybody, are you following what I am saying? That is why they say futures price should be more than what? The spot price. Now, so they gave the equation, future price is equal to what? Spot price plus cost to carry. Yes or no? Now, what are all the examples of this cost to carry? Can tell me the example? One is what? Storage cost. I may take what? Insurance. I may sometimes have what? Transportation cost, handling cost. Everything will be what? Incurred. And more importantly what? The financing cost. All this will be given as what? Cost to carry. Yes or no? Now, for share and all, we don't have storage cost, transportation and all. Yes or no? But still, share also may having what? Cost carry, may financing cost. Yes or no? It is better to have a TCS futures buy than what? Buying the TCS today. The reason is what? When I buy the TCS today and hold the share, I lose interest on the money invested. Yes or no? Futures contract, I don't invest my money except for the margin money. Leave the margin money interest, that we don't go deep into that. So it is better to have a TCS contract futures buy rather than what? The TCS share. Because TCS share involves investment. TCS futures no investment. No investing margin money. If you buy TCS share, 100% money should be invested here. Margin money is just 5% only. Everybody yes or no? That means the capital is what? 5%. ரொம்ப simple. A person buys a TCS shares today at 1,000 and sells after what? 1 year at 2,000. Example, how much profit he made? 100,000 rupees profit. He made by investing how much? 1,000. Do you understand or not now? Listen here, yeah. You are buying a TCS share today at how much rupees? 1,000. And selling after 1 year how much rupees? 2,000. What the profit made by you? How much rupees here? 1,000. And how much investment? 1,000. What the profit percentage? 100%. Now, what happens is, imagine like this. I don't buy TCS shares. I buy what? TCS futures. I buy what? TCS futures. For the same 1,000. For what? Same 1,000. And after 1 year, the share is trading at what? 2,000. How much I book as profit here? 1,000. So TCS share also gave me 1,000 profit. TCS futures also gave me what? 1,000 profit. Yes or no? But for TCS futures, nothing I invested today. I only book the profit and loss. That is, I don't have what? Nothing. Still what? I book the profit and loss. Are you following what I am saying? Without investing a single rupee, I earned what? 1,000 by booking profit and loss. Are you following what I am saying? But if at all you want to consider investment, I invest a margin money. I invest what? Margin money. Suppose 5% margin money means I invest only what? 50 rupees and earn 1,000. See the rate of return very high. Yes or no? Why? Because there's no carrying cost, there's no cost to carry the asset, because I don't have an asset, I only have what? Contract on the asset. Yes or no? Always contract on asset is very light, and asset is what? Heavy, because contract need not be carried, asset should be what? Carried. So the contract price should be more than what? The spot asset price by the cost of carry amount. You know, follow what I am saying? This is what I just wanted to communicate here. So very simple concept only. What is futures price? Spot price plus cost to carry is the futures price. Everybody up to this, are you following or not? Now, see. Okay. Sometimes futures price may be less than spot price. Always we believe that future value should be more than what? Present value. So we say future price should be more than what? Spot price. To the extent of what? Cost to carry. Now, sometimes future price can be less than what? Spot price. Spot price of the share is 2,000. Futures price is 1,900. Can it be possible or not possible? Perfectly possible. Is what? Perfectly possible. Can you imagine when it is possible? Exactly. When some income arises from the share, I am just taking from share's point of view, when some dividend is what? Declared in between, where the dividend amount is much more bigger than what? The financing cost or cost to carry, then the future value can be what? Less than the spot value. You want to have a classic example, we did that option problem in currency. Never gaba. Invest $1 spot is 50 rupees, but after 1 year the IRPT how become what? 47 rupees or something. Remember or not? Because the rupee earned cost only 10%, but the dollar earned me how much? 15%. I had a minus 5% cost to carry. Yes or no? Now, in that case, where the cost to carry is less than the benefit I derive from what? Asset. In such case, it is going to be what? Very much higher. Response is or no? Now, that means what I say is future price can be called as spot price plus I spend some amount to what? Carry the asset. I call as what? Cost to carry. The asset, by carrying asset I get what? Some benefit that I call as convenience yield. I call as what yield here? Convenience yield. I am discussing all this only to make use to familiar to what? Concept. These concepts are not new to us. We discuss all this somewhere here and there. Everybody follow what I am saying? I am putting the terminologies into this concept, that's all. Are you following what I am saying? Now, see, I have an asset. Okay. Instead of holding a share, instead of holding a futures contract, I hold the asset itself. Remember? Instead of having a futures buy of TCS share, I am having what? TCS share itself. Tell me, what is the disadvantage of having TCS share? I have to incur what? Cost to carry because I pay money to buy the share. On that money, interest is lost or financing cost is involved. So no, it's called as what? Cost to carry. Now, but when I have a TCS share, 6 months TCS futures, third month TCS declares a dividend. By having a share, I can receive what? Dividend. But having a futures, I cannot receive what? Dividend because contract is not an asset. It cannot give me income from the asset. It's not what I'm saying. In that case, to that extent, the futures price is get reduced by what? The convenience yield. Convenience yield means what? The benefit which I get by holding the asset. Everybody, are you follow what I'm saying? Should I repeat once again? Now, tell me, see, you have TCS shares, you have TCS buy futures. Okay. One thing is common. At the end, that is 6 months futures. How many futures are? 6 months futures. All of you listen. Two options here. Option 1, we have TCS shares. We have what shares here? TCS shares. Number 2 is what? We have a 6 months TCS futures. Up to this understanding? At the end of 6 months, both will give you TCS share. Already having TCS share, you continue to have till what? 6th month. And future 6 months buy also gives you what? TCS share. I am going to have the asset at the end of what? 6 months in both the scenarios. So no. But when I have TCS share today, I invested money in the share or not? To the amount invested, I lose what? Interest. That's the cost to carry. But I don't invest money today in what? TCS futures contract. Number 2. When I have a TCS share, if the share declares dividend at the end of what? 3rd month, I can receive by having a share. So no. Can receive a dividend by having the share or not? Having a futures contract? No. In that case, futures contract, we don't carry the asset. When I don't carry the asset, I neither incur cost to carry the asset, nor get what? Any yield from that asset. But if I have the asset, I have what? Cost to carry the asset, as well as what? I have a yield from that asset. So to the spot price, if I add cost to carry, I'll be getting what? Futures price. If there is no yield from the asset, yes or no? No. In that case, the carrying the asset and what? Futures, both are what? Equally good. And if I have a convenience yield, the spot price plus cost to carry minus what? Convenience yield will be giving you the futures price. Are you following what I'm saying? Now, I'll give you one more example where having an asset is beneficial than having the futures contract. Now, see, suppose I'm discussing about a bag of wheat. I'm discussing about what? A bag of wheat. Okay. Wheat and will not give dividend. Will not give you what? A dividend. Then in that case, commodity, how we can understand what? Convenience yield. I'll give a simple example. See, today the wheat bag, say, is selling in the market, and I'm just saying openly, I don't know any market price of a bag of wheat, how it is in the futures market and all. I don't track it. That's what I'm saying. Just whatever comes to my mouth, I say. So don't question me. Can I say? Illa, only imagine the example. Today a wheat bag is selling at 2,000 rupees. How much rupees here? 2,000 rupees. Okay. Now, futures wheat bag, suppose is selling at 1,500. How much rupees here? 1,500. One may wonder, sir, today wheat bag is how much? 2,000. How a wheat bag after what? 6 months. After what's our example? 6 months. He is studying how much rupees? 1,500. Your question may arise. Yes or no? Now, I can say like this. Now, we are expecting a supply shock. We are expecting what? A supply shock. Supply shock means sudden scarcity of what? Supply of wheat. It's called as what? Supply shock. Okay. Whenever there's a supply shock, the price of commodity shoots up very high. Yes or no? Because people cannot postpone consumption of commodity. We cannot say supply of wheat is very less. Let me eat wheat after the water. Supply comes. This is all bread and butter. Every day people consume daily. Are you what I'm saying? In that case, today, if the wheat is having a supply shock, or in another 1 or 2 days, we are expecting not a so good rainfall in this 1 or 2 months, so there is a great demand for wheat, so it may be trading at what? 2,000 rupees, very high price due to what? Supply shock. Yes or no? But everybody believes that in another 3 months, there is going to be a good monsoon and the supply shock is going to get what? Released. So after 3 months, everybody in the market believes that the supply shock is going to get over. It will be having what? A good harvest and the supply will come very much and the prices are going to fall. Yes or no? Now, tell me, When I have a 6 months wheat futures, when I have what? 6 months wheat futures, I'll get the wheat only when the supply shock is over. Yes or no? At that time, will anybody price the future the same 2000 or no? Because I get the wheat only when the supply shock is over. I don't have a benefit of what? Selling that at the high price when the supply shock is present. Yes or no? But now when I have the wheat, I can sell it during what? The supply shock period itself and make a huge profit. Everybody, yes or no? No. Like come dividend, ex dividend, we can say it is a come supply shock price and next is what? A post supply shock price. In that case, it is better to hold the wheat back than what? Hold the wheat futures, because when I hold the wheat futures, I get the wheat only after what? Supply shock is over. When I hold the wheat back, I'll be having it what? Today itself. Everybody, are you able to understand it or not? Now, sometimes it is better to hold the commodity when there is a convenience yield. Now, this 2000 minus 1500 only, I call as what? The convenience yield of holding a wheat. Suppose the cost to carry is nil. Everybody able to understand what I am saying? So, this is what we call as a convenience yield for a given asset. Okay, now, nothing great we discussed. Future price should be same as spot price. Solluba. Futures price is equal to spot price. True or false? False. When I have a asset purchase, when I have an asset, the disadvantage is I should spend what? Cost to carry an asset. So spot price plus cost to carry an asset should be equal to what? Future price. Point number 1. Accept or not? No. Next. When I have an asset, I don't only have the cost to carry, the asset also can generate me what? Income. That is what we call as what? Convenience yield. So spot price plus cost to carry minus what? Convenience yield will be giving me what? The futures price. This is the second formula. Everybody, are you understanding it or not? Now, next is. All are same formulas only, nothing great. Can I proceed further? Now, see. From this, we can say two things. Futures price can be more than spot price, can also be what? Less than spot price. When the future price will be more than spot price, when cost to carry minus convenience yield is what? Net cost to carry. Can I say no? Now, cost to carry is 100. Convenience is going to be how much? 50. I'll be having what? Future price more than the spot price. When I have a net cost to carry, the future price will be more than what? Spot price. Opposite. When I have a net convenience yield, when I have what? A net convenience yield, where the convenience yield is more than what? Cost to carry, the future price will be what? Less than spot price. Now, that means futures price can be more than spot price, can also be what? Less than spot price. When it's more than spot price, I have a net cost to carry. When it is less, only what? A net convenience yield. Please respond. Are you following what I am saying? Now, so see here. There are two situations. One is what? Futures price greater than what? Spot price. Next is what? Future price less than spot price. I think you are following or not? Now, this is due to what? Net cost to carry. Is due to what? Net convenience yield. Everybody, are you following what I am saying? Now, see. What they do is, they call something called as basis. Nothing simple calculation. They call as what? Basis. Basis is nothing but spot price minus what? Future price. Ignore time value of money. Base nothing but what? Spot price minus future price. Now, if spot price is more and future price is what? Less, the basis is what? Positive or negative? Yeah, positive. Spot price is more, future price is what? Less. The basis is what? Positive. When the basis is positive, the future price is what? Less than spot price. When I have a net convenience, the basis is what? The basis they call as what? Positive. When net cost to carry, tell me the basis is what? Negative. Very simple. Yeah. What is basis? Spot price of the asset minus what? Future price. Spot price more than future price. What has happened to basis? Basis is what? Positive. Spot price is more than future. The base price is what? Positive. And spot price is less than future. The basis is what? Negative. Negative basis. I am having a net cost to carry. Positive basis means what? I have a net convenience yield. Why I am saying is, in one of the exam question, they gave me the spot price and basis. Okay, you should know that if I add or subtract base, I'll be getting what? The future price. Hence, I am making you used to what? The terminologies. Everybody, yes or no? No. Please tell me. Should I repeat once again? Now, I'll tell you once again. Romba simple. Now, don't worry. We'll consolidate and then proceed. Now, romba simple. Whatever discussing, chapter matter is what very not at all worth spending. But terminology is yours. One should be what? Understanding. You are new to it. That's okay. Romba simple. Future value is present value compounded. Future value is what? Present value compounded. Future price is spot price compounded. Yes or no? Now, in the compounding, number cost to carry. Common is what? Cost to carry. I'll write the other formulas later. Are you following not? Now, why spot price cannot be equal to future price? Because when I buy the asset at spot, I have to what? Carry the asset. We hold the futures contract at future price. I need not what? Carry the asset. So spot price is having a cost to carry. So cost spot price plus what? Cost to carry should be equal to what? Future price. For both to be equal. Are you following what I am saying? Now, next is spot price plus cost to carry is future price. Now, what is spot price? Holding an asset today. And what is the cost to carry? Cost of holding an asset. That should be equal to what? Getting the asset after 6 months. Yes or no? Now, but when I hold the asset, I not only incur cost in holding the asset may even give me what? Income. Can even give me what? Income. Like holding a share can give me what? Dividend. Holding a bag of wheat may help me to exploit what? A supply shock and so on. Everybody, are you understanding it or not? In that case, spot price plus cost to carry minus what? Convenience yield is going to give me what? Future price. Now, suppose there is no cost to carry, there is no convenience yield. For example, no storage cost, interest rate is 0%, no dividend, nothing is there. Spot price is equal to future price. There's no cost to carry, no convenience yield. Then holding spot, holding a future is what? Same only. Spot price is equal to what? Future price. But when I have a cost to carry and convenience yield, future price should be different than what? Spot price. It's not no now. If the cost to carry the asset is more than what? Convenience yield, then the future price should be more than what? Spot price. So future price more than spot price when I have a net cost to carry. Now, when the cost to carry is less than the convenience yield, then the future price should be what? Less. So what happens? The future price is what? Less than spot price. When there's a net convenience yield. Up to this, I will follow now. Rumba simple, they said one thing. Take the spot price, take the future price. Today the share is trading at 1200. Futures market, the same share is trading at 1300. What's the difference? 100. Which I call a spread. Which I call as what? Which I call as what? Basis. Which I call as what? Basis. So spot price is 1200. Future price is what? 1300. 1200 minus what? 1300. The basis is what? Minus 100. The basis is negative. Yes or no? The basis is what? Negative. When the basis is negative, I say I'm having what? A net cost to carry. Now, suppose the futures price is 1200. Spot price is what? 1300. The basis is what? 100 positive. In that case, what happens is I'm having what? A net convenience yield. Yes or no? Yeah, negative positive basis means what? Convenience yield. And negative basis means what? A net cost to carry is the next indication. Everybody, are you understanding it or not? See. From this we all can know that futures price and spot price are different. Yes or no? One may be higher than another depending on the basis. Are you following up? Now, look at this. Can I proceed? See. Both diagrams are same or different? Same. Yes or no? Now, only change is, now, see first. Futures price, spot price. Future price is what? Spot price. Next is what? Spot price and then futures price. Can I present not? Now, see. In this case, future price is more than what? Spot price. Why it is more? Because the cost to carry is more than any yield from holding the asset. Yes or no? Now, so this future price are gone from the futures market. Spot price is gone from what? Share market. For different day, today, tomorrow, every day, I just work. Put on the points. This is a future. This is what the spot price. Like this, there's a diagram. Yes or no? Now, understand that when the futures nears maturity, when the futures what? Nears maturity date, it will be coming closer towards the spot price. Yes or no? Now, today 6 months futures. Then after 3 months, it becomes what? 3 months future. It is a 3-month future. It is closer to spot. Yes or no? 2-month future what? Much more closer to spot. On the last day, the futures and spot are what? Same only because there is a contract on same day. Everybody are you follow what I am saying? So now we all know that as the futures contract nears the maturity date, as the nears the maturity date, it will always come closer to what? The spot price. This is very important. Now, in this case, when it reaches the maturity date, it should be same as what? Spot price. This concept they call as convergence. They call as what? Convergence. Convergence means what? The future price and spot price become same. When they become same, on the maturity date the futures contract is spot contract only. Yes or no? Now, when I'm far away from maturity date, the cost to carry a conversion may be seeming what? Bigger. When I keep on narrowing, what happens here? It is going to be what? Reduce. On the last day, it becomes what? The same. Either we call it a convergence. Yes or no? Now, the gap between future price and spot price, what they call as what? Basis. They call as what? Basis. Basis is wider as I am far away from what? Maturity date. As I near the maturity date, the basis becomes what? Narrower and narrower and narrower. While the basis on the maturity date, 0 is the meaning of this. Ennappa, right or not? Now, this basis is negative. The basis is what? Negative. When the future price is more than what? Spot price. Now basis formula spot price minus what? Future price. Here the basis is what? Negative. Here the basis is what? Positive. Everybody yes or no? Now, for a particular asset, when the diagram for futures is looking like this, now tell me basis is positive or negative? Negative. Future price more than spot price or not? Yes. This we call as contango. We call as what? Contango. The futures market is at what? Contango. Contango means what? The future price is always more than what? Spot price. We call as what? Contango futures market. Everybody yes or no? Now, in this case, we call as backwardation. We call as what? Backwardation. That means the spot price is more than futures price. The spot price is slowly coming back towards what? Future price. Yes or not? Now, here the spot price is what? Slowly going up towards what? The future price. Everybody, are you following what I am saying? So this is called as a contango. It is called as what? A backwardation. No great concepts. Only thing is to be aware of what? All these terminologies. Now, so now tell me, why contango occurs? Because of cost to carry. Why backwardation occurs? Because of what? Convenience yield. Okay. Now, if an asset is said to be having lot of convenience yield, it should be in what? Backwardation in the futures market. Contango comes when they have what? A net cost to carry. Yes or no? Contango, the basis is what? Negative. Backwardation basis is what? Positive. Up to this, everybody, are you following or not? Discussion. Now, last point. See. A wheat future, 6 months future is what? 6 months futures. Now we said contango is now at what? Contango. That means what? The future price is more than what? Spot price. Can a 6 months wheat futures today at contango, can it go for backwardation tomorrow? What? Yes. When the information comes about supply shock, it goes into backwardation. Everybody yes or no? Yeah. Wheat future which is at backwardation tomorrow can become contango once again or not? Yes. Once the supply shock becomes what? Over. Convenience yield has been lost. It once again converts back to what? Contango. Everybody yes or no? The contango and backwardation are not a permanent future, not what? A permanent feature. It is all depending on what? The information which I give. Always prices are nothing but information. Share price and discuss in dividend policy. You know what is share price? Information about the company only reflects in what? Share price. Like the information about the commodity, information about the share will also affect what? Futures price. A future now what? Contango can go into what? Backwardation, and later backwardation come back to what? Contango. When the backwardation comes to contango, when convenience yield is over. Now, 3 months a TCS share information is going to declare dividend after what? 3 months. 6 months TCS future example. That's what I am saying. In that case, up to 3 months the share may going at backwardation. But once a dividend is declared at the end of the 3rd month, it will move into what? Contango because no future dividend to be received by holding the asset. Yes or no? So in the contract can either be a contango or backwardation. It all depends on the perceived convenience yield and cost to carry is the last point I just wanted to discuss. Now in this, anything great has been discussed. Future price can be more than spot price. can be what? Less than spot price. Tell me what is future price? Spot price plus cost to carry minus convenience yield. Okay, cost to carry is the cost of holding the asset. Convenience yield is what? Benefit I get from holding the asset. That should be adjusted to find out what? Future spot price. I will find out what I am saying now. The future price can be more than spot price or can be what? Less than spot price. When it will be more? When I have a net cost to carry. When it will be less? When I have what? A net convenience yield. What is basis? Spot price minus future price. Basis negative means what? The net cost to carry. That is a net cost to carry. Basis positive means what? Net convenience yield. This is a diagram for futures price and spot price. And here the basis is what? Negative. I'll just write here basis negative and then what? Basis positive. Okay. Basis is negative. I call as what? Contango. Basis positive I call as what? Backwardation. Backwardation arises due to convenience yield and contango arises due to what? The cost to carry. It's not no. Now we draw the diagram much more simply, but really how the diagram looks like is it will looking like this. This is it's going to be what? Because future market also price may go up and down, etc. It's not no, but overall if you see the graph will be what? Sloping downwards. It's not like that will be sloping what? Upwards. And this is called as what? Convergence. Now, and it is going to be what? Otherwise, same diagram only I put what? Spot, I put what? Future. That is, every market price may go what? Up and down temporarily, but if I see the pattern, I will be able to understand what is in contango or what? Backwardation. Everybody, are you following or not? And finally, can a backwardation become contango? Yes. When it becomes once the convenience yield has been exhausted. Can a contango become backwardation? Yes. Once you get the information about what? A new convenience yield. Everybody, are you following what I am saying? Now, next. On maturity date, the spot price should be equal to future price. It should be equal to what? Future price. If it is not equal, what happens here? Arbitrage. What exists here? Arbitrage. It is called as cash futures arbitrage. What arbitrage? Cash futures arbitrage, where you can buy in a cash market or sell in the cash market, buy or sell in what? Futures market, because on the last day, the two markets are exactly same only. When they have different prices, one can buy and sell in what? One another and make a profit. It's called as what? Cash futures arbitrage. About that, we'll discuss the problem later. Everybody are you understanding it or not? Now, this is what is some of the extra theories which we wanted to discuss regarding the futures. Is not a pure theory we don't have discussed. Examination question gives you basis or running at contango, backwardation, convenience yield. When the terminologies are used, one should be able to understand what they are trying to mean by that. Yes or no? That's why elaborately these issues has been discussed. Now, next. Don't get angry with me. Tell me, futures price is equal to what? Plus cost to carry minus convenience yield. Okay, next. Don't talk. Future price is equal to, they may give you the cost to carry at 10%. Convenience yield as what? 6%. What I am saying? That is, they may give it as what? Percentages. In that case, it is very simple. It is spot price into 1 plus R minus C. See, R minus CY, I can have convenience yield. Is going to give me what? The future price. Simple compounding. Ennappa, right or not? No. Or future price is equal to raw price into e power T R minus convenience yield. And the D only put as what? Convenience yield here. So no, e power T R minus Y. Enna purinjudha? No. Very simple. Spot price plus R power N, I forgot, R power N. Spot price into 1 plus R is what? The cost to carry. It is the interest cost plus what? Storage cost in percentage. IP is evoke is some holding cost per unit per annum they gave it. Yes or no? No. That's what they call as the cost to carry minus what? Convenience. This may be dividend, this may be what? A supply shock yield, etc. They given percentage. And if you want to have a continuous, what happens here? Future price is equal to spot price into e power T R minus CY. Now, next. Sometimes they may give the convenience yield in what? Rupees. Very simple here. future spot price is equal to revised spot price into 1 plus R power n. The R is what? The holding cost in power n. What is revised spot price here? Spot price minus convenience yield, or you can also call as correctly present value of convenience yield. Spot price minus present value of convenience yield. Other you call as spot price minus present value of dividend. Yes or no? And the dividend only we call here as what? Convenience yield. This is calculation. Everybody, yes or no? That's how one should calculate the future price. Now tell me, future price is equal to spot price plus cost to carry minus convenience yield. It is a very normal, very primitive formula. Yes or no? Now, if they give you the cost to carry and convenience yield as a percentage, what is future price is? Spot price compounded at 1 plus R minus convenience yield. If you do the continuous compounding, spot price into e power t R minus convenience yield. And when they give you the convenience yield in what? Rupees, after some time, I write as what? Future price is spot price minus present value of convenience yield. I call as revised spot price into what? 1 plus cost to carry power n gives you the amount. Everybody, yes or no? Now, we'll write a notes up to this, and then in another 10 minutes, you can believe another 10 or 15 minutes, we can do all the commodity futures calculations, nothing but compounding calculation only, and then go for the futures arbitrage. Now, first of all, those who understood what I discussed or listened to what I discussed, raise your hand. Are you all following? Okay, now. Can I proceed? Okay. Now, say, write down. Understanding futures price. Give the heading, understanding futures price. Understanding futures price. Point number 1. It is generally advantageous. It is generally advantageous to have a contract to buy an asset. It is generally advantageous to have a contract to buy an asset rather than, it is generally advantageous to have a contract to buy an asset rather than what? Buying the asset itself. Rather than buying the asset itself. Rather than buying the asset itself. Point number 2. This is because having the asset involves cost to carry the asset. Having an asset involves cost to carry the asset. Involves cost to carry the asset. Like having an asset involves cost to carry the asset like what? Storage cost. Like storage cost. Handling cost, insurance, financing cost, etc. Handling cost, insurance, financing cost, etc. Are you following what I am saying? Which futures contract does not have. Where a futures contract does not have. Which a futures contract does not have. Point number 2 or 3 or 3. Thus, we can say that futures price is equal to, thus we can say that, by the separate line, futures price is equal to, can you fill in the blanks? Spot price plus cost to carry. Futures price is equal to spot price plus cost to carry. Futures price is equal to spot price plus cost to carry. Everybody understanding it or not? Now, next point number 4. Sometimes it is better to have an asset. Sometimes it is better to have an asset rather than have a contract on that asset. Sometimes it is better to have an asset rather than have a contract on that asset. Whenever contract, I mean always what? Futures contract. Sometimes it is better to have an asset rather than contract on an asset. Full stop. This happens when the asset gives. This happens when the asset gives an income during the contract period. This happens when an asset gives income during the contract period. When asset gives income during a contract period. Everybody, yes or no? For example, dividend declared. During the futures or option contract period. Dividend declared during the future or option contract period. Dividend declared during futures or option contract period. In a futures, what is true? True for what? Option also. During futures or option contract period. Can I proceed? Next. Point number 5. This benefit which a person derives by having an asset. This benefit a person derives by having an asset. This benefit a person derives by having an asset is called. This benefit a person derives by having an asset is called what? Convenience yield. Within quotes, right? Convenience yield. Thus, full stop and right. Thus, separate line. Futures price is equal to. Thus, futures price is equal to, fill in the blank, spot price plus. Future price is equal to spot price plus cost to carry minus convenience yield. Future price is equal to spot price plus cost to carry minus convenience yield. Everybody, are you following or not? Next. Point number 4, 5 or 6? Point number 6. Center right situation branched into 2. Center right situation branched into 2. Two things can happen here. Future price greater than spot. First branch, future price greater than spot. Second branch is what? Spot price as future price less than spot. Second branch, future price less than spot. Tell me why the future price is more than spot price? Net cost to carry. I have a net cost to carry. Why future price is below spot price? Net convenience yield. Net cost to carry, net convenience yield. Net cost to carry, put a down your mark and write. Basis is what? Negative. Base is negative. Second branch, base is positive. Base is negative. Second branch is base is positive. Point number 6 or 7? 7. What is basis? What is basis? Question mark. Very simple. What is basis? Basis is the difference between spot and futures price. Basis is a difference between spot and futures price. Basis is a difference between spot and futures price. Basis is equal to spot price minus futures price. Basis is equal to spot price minus futures price. Can I proceed or not? Now, point number 6 or 7 or 8? Point number 8. Now, copy this diagram. I will draw for you. Let us do it together now. Point number 8. Point number 8. Copy this diagram. Don't do scale and all. Copy quickly. Simple. Now, what is in x-axis? Time. Now, price moves with the time or not? What is in y-axis? Price. Can I proceed now? Normally, futures price more than what? Spot price. Normally, future price is higher, spot price is what? Lower. All these prices I got from the futures market, I got from what? Spot market. Now, next is what? Spot price more than futures price. Tell me the name of this diagram. What is the name of this diagram? Contango. Contango. What is the name of this diagram? Backwardation. Backwardation. The name is what? Backwardation. Contango, backwardation. On maturity they meet or not? Now, this meeting point, tell me the name. What is the name here? Convergence. The name is convergence. 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 The name is what? Convergence. When they meet, it is called as convergence. Can I proceed now? Now. Write down point number 8 or 9? 9. I think you should have done along with me. Right or not? No. And I just forgot here. In this case, basis is equal to what? Negative. In this, basis is what? Positive. Basis is negative, basis is positive. Base is negative, base is positive. Can I proceed or not? Next. Point number 8 or 9? 9. Right, point number 9. The basis narrows. The basis narrows as the futures nears maturity. The basis narrows as the futures nears maturity. The basis narrows as the futures nears maturity. On maturity, full stop and write, on maturity, ideally, what should happen? Basis should be 0. On maturity, ideally, basis should be 0. That is, spot price is equal to futures price. On maturity, ideally, basis should be 0. That is, spot price is equal to futures price. Spot price is equal to futures price. This is called what? Convergence. This is called convergence. This is called convergence. Can I proceed or not? No. I think I need not explain what is contango, what is backwardation, because it is there in the diagram itself. No need to have a sentence for that. No. Next, point number 9 or 10? 10. Point number 10. Can a contango futures go into backwardation? Can a contango futures go into backwardation? Can a contango futures go into backwardation? Question mark. Answer me. Yes or no? Write down. Yes. When? Yes. When what happens here? Information about when information about a convenience yield emerges. When information about a convenience yield emerges. When information about convenience yield emerges. When information about convenience yield emerges. Are you following or now? Earlier I am having a 6 months TCS futures, 2 months over, it is a contango. Suddenly TCS declares a dividend in another 1 month. What happens here? Moves into the backwardation. Everybody understanding it or not? Now, next. Point number 10 or 11? 11. Can a backwardation move into contango? Can a backwardation move into contango? Question mark. Yes or no? Yes. When the convenience yield is exhausted. Yes. When the convenience yield is exhausted. When the convenience yield is exhausted. When the convenience yield is exhausted. Respond yes or no? No. With this we complete these particular terminologies. To be frank, nothing has been discussed. We discussed about future price and spot price. With lot of terminologies, one should know how to use it. Everybody yes or no? Now let us do some problems quickly in commodity futures. Like stock as an underlying asset will be having what? A gold or a wheat, bag of wheat. It may be what? A bale of cotton can be the underlying asset on the futures market is created. Now please. Commodity futures is traded in CMX. Okay, in the commodity exchange is being traded under. Other futures are traded in the NSE. Can I start or not? Now take question number